Welcome back. It's been a while. My name is Adam and you're watching Unlimited Options Investing. In this video, we're going to be talking about stocks, crypto, when I think eventually the market will turn around, as well as my favorite part, technical analysis. Now, guys, the elephant in the room, there's no way to sugarcoat it. 2022, investing has been awful. Literally since the first trading day of the year, it has felt like we have been going down week after week after week, with the exception of the middle of March to the end of March, where we had that first rate hike and it looked like we were out of the woods. We were going to recover, all-time highs, correction is over. What happened April, which was one of the most statistically the best month of the year, was downright awful, and May and June were no exceptions. We were just coming off one of the worst weeks we've had since 2020. We all know what happened in the crash of 2020, and we're seeing levels that we haven't seen since 2020. So it's been crazy out there. It feels like a confluence of just every bad news thing is happening at the same time. And it's not like it's news that we can just brush off. It's real life things. It's geopolitical issues. It's Fed policies, inflation, consumer sentiment, layoffs. You're seeing the word recession everywhere you go, left, right, and center. It's negative after negative after negative. We're seeing pessimism. We're seeing everyone saying, don't buy right now, wait until this time. And it sucks, guys. If you're a long-term investor, then you're really feeling the heat, especially if you got into a lot of technology, if you got into options. Like myself, you're feeling a whole world of pain. If you're a more conservative investor, you're still feeling the pain, but not nearly as much. And if you got into energy or you cashed out at the end of 2021, please let me know which crystal ball you have, so you can share it with Unlimited Options Investing. Otherwise, guys, we just have to look forward and try to preserve the capital that we still have and try to make more gains looking forward. You can't dwell on the past. You can't think that, oh, I haven't sold, I haven't lost because I haven't sold yet. Well, you know what? Look at your market value. You have lost that market value since the beginning of the year, as we all have. We've got to move forward. And crypto, Bitcoin, Ethereum, all the altcoins have been getting demolished more so than stocks, and stocks have been pretty bad themselves. Bitcoin was probably at 40,000 maybe a month and a half ago. Now we're under 20,000 or hovering around 20,000. That is a 50% drop in just a matter of a few weeks, but that's crypto for you. And a lot of people that have been investing in crypto for a long time into Bitcoin, Ethereum, are used to it. They're used to that 70 to 90% drop. It's normal and they welcome it because that means it's part of the cycle and that's it. Now, everyone's saying Bitcoin has always dropped 70, 90% or whatever and eventually recover to new all-time highs and more. Yeah, that's true. It doesn't necessarily mean it's going to happen again. It may very well happen and the cycle will continue and continue, but maybe not. So you have to be really fallible. You have to be realistic with yourself. You got to tell yourself, hey, listen, just because something's happened in the past doesn't mean it's going to happen again. So again, guys, we'll take a look at all the charts. It's been bad. Looking at the past 20 so years of the S&P 500, what we're going through right now is no joke. It's on par with back in 2020, 2018. That correction back then looks like a blip on the radar. And even going back to the Great Recession back in 2008, 2009. Again, this one doesn't look nearly as bad, but we have to take into consideration that the market was down pretty much 50% from peak to trough. So even though right now we're losing a similar amount of basis points off the indice, we do have to take into consideration that now market caps are much higher than they used to be. There's many more trillions of dollars in the system. And if we are indeed in a recession or entering one, we may potentially have a lot more pain to go. Though, again, it's anyone's guess where that bottom could be. And again, no matter where you're looking these days, CNBC, Yahoo Finance, Google News, wherever, anywhere you're looking, you're seeing keywords, inflation and recession fears, why the housing market's about to crash, pro-vanilla investments. So everyone's looking at getting into more conservative, risk-off assets. And actually, one thing I want to take a look at is the margin statistics, the amount of debit balances in customer securities margin accounts. So at the beginning of the year, we were at over $829 billion. And if we look back at 2020, during the crash, we were at $479 billion, 524, so around $500 billion, and then gradually increasing as more money was flooding into the system. You look at 2021, and they kept ballooning month over month to a peak of about $935 billion, almost $1 trillion in debit balances in margin accounts. The lower we see this going, the better it is. For the long term, we don't want to see this inflated at all, because it just means that the bubble is getting bigger and bigger. So it is encouraging to see this number get to more normal levels, although we are still pretty elevated, especially relative to those 2020 levels. People are getting margin called, people are getting liquidated, so it is ugly to see, but again, it's the nature of what's been going on for the past couple of years. In fact, a lot of people would probably say we have been on borrowed time for the past 15 years, ever since the Great Recession, when big banks got bailed out by the Fed, and even in 2020 when all of America got bailed out by the Fed. We take a look at the heat map of the S&P 500, guys. It's been ugly out there. Other than energy, which is up, making record profits this year, technology got absolutely routed. Banks have been getting decimated. Healthcare, not so good. Even what we all thought was risk off in Coca-Cola, Pepsi, tobacco, consumer defensive, and Walmart and Costco, things are in the red or borderline break even, so it's not a good situation. Apple down a quarter of its market cap since the beginning of the year. It was around $3 trillion. Right now, much lower. Microsoft, similar idea. Nvidia almost down 50%. Qualcomm down 33%. AMD 43%. Google down 25% like Apple and Microsoft. Meta Platforms down 50%, very ugly. Amazon, which recently went through a stock split, down 36%, and Tesla down 38%. And the thing with Tesla, which I find really interesting, is that it actually lost a lot of its market cap in just the last couple of months. So if you look year to date, so we started at around $1,200, and we went down to again $750 near that first rate hike. We had that awesome rally, reaching almost that all-time high, again where we were at the beginning of the year, and we've lost 45% pretty much since then. Almost 45%, again near where we were at the beginning of the year. So it's been very volatile. It's been very, very, very rough. It's been stomach churning. It's been, that turbulence when you're on an airplane and then it goes down. This is exactly the same idea, but what happens at the end? You safely land at your destination, and then in terms of stocks, you just hold on for dear life. You hold on to something, you do something else, and then over the long term, you stick to your plan, and it should, keyword should, end up working out. Everyone's favorite coin, Bitcoin. Where did it all go wrong, guys? It has been super, super ugly, and similar to Tesla, where it's been decimated for the better part of only 2 or so months. Same idea with Bitcoin. We were just at 40,000, which was also well off its all-time high that it hit back in November of just under 70,000. So on May 4th, we were just below 40,000 on Bitcoin, and in about a month and almost 2 months at this point, we had elevator down, sideways action, maybe we'll recover, maybe not, and then same idea, another elevator down, pretty much 50% from those levels back a month and 20 days ago. So just below 2 months, 50% off its market cap. So again, just under 2 months, and you have a 50% haircut in Bitcoin, and that's even after it fell maybe 30% from its all-time high back in November, which was again 70,000 to 40,000, about a third of its market cap, and then from that point, 50% in less than 2 months. Volatility at its finest. And we look at the charts for Bitcoin, and we see elevator down back in May, elevator down maybe 10 days ago. If you turn your attention to back in December and January, I drew this trend line. We did break out from it. It was encouraging, but we did start trading sideways, which was okay. It wasn't like we were breaking down at the time. And we even broke out from this $45,000 mark at the end of March, which coincided with that time where it looked like risk on was entering back into the market. But again, April was not very friendly to investors of both stocks and crypto. And even it looked like we were breaking out well above that $46,000 mark, which was a very key area at the time. But we got faked out, and we started consolidating back in that area. Again, no real cause for concern yet until that sharp sell-off back in the beginning of May, and then again back in June to where we are right now. Everyone's hating Bitcoin, even though when we were at 20,000 back in 2020, over here everyone was like, Bitcoin is the greatest thing ever. It's everyone buy Bitcoin. Even back over here around 70,000, even the first time I hit 70,000, everyone's like, I missed the boat. If it ever goes back down again, I'll buy as much as I can. and now that we're here, no one wants to touch it. The classic case of when everything goes up, everyone wants a piece of the pie, but when things go down, no one wants to touch it. Classic psychology. So on Saturday, we did get a green candle, which is a little bit of a relief, but I wouldn't hold my breath because any buying pressure really with stocks and crypto has been met with selling pressure, and it's not like we've crossed any key area. I mean, we are holding a psychological area of 20,000, a very round number, 10,000, 20,000, 30,000, so we're trying to hold the psychological area, but again, we're still below that 20 EMA on the weekly. We're still well below the 50 EMA, and most likely until we see a reversal also in stocks, Bitcoin is also going to be seeing a lot more declines, again being a pure risk on asset. The market wants nothing to do with risk on and just wants safety, whether that's in cash, whether that's in consumer defensive stocks, or whether that's in energy stocks. People want just to get out of the risk on, they want the pain to end. So crypto has been an absolute disaster. We take a look at the S&P 500, and even this one, we're seeing gap down. It's volatility, up, down, chop side to side. It's rough out there, guys. So back in May, it looked like we had a double bottom in this area. We were recovering, and then we went down a little bit. We had filled in the gaps. And in this area over here, June 9 and June 10, is when we got that CPI report. And in my opinion, if the CPI was better than expected, I think this would have actually gone up. Because the CPI was absolutely brutal and much worse than we thought, we gapped down not once, but twice, and we're even lower than we are right now. Actually, we gapped up a third time, and now we're even lower than that area over there, 52-week lows. There's no reason to think that this is the absolute bottom as where we are right now. We could for sure have more downside to go until we get some kind of positive news or positive catalyst moving forward, and it doesn't look like that's coming anytime soon. Looking at the DXY, the US dollar currency index, gaining a lot of strength over the past year relative to the other major currencies in the world. So the Chinese yuan, the Japanese yen, the Canadian dollar, the British pound, the euro. It looked like we found some weakness in the middle of May, but then again hitting that 50 EMA, the CPI coming out, and then more people going into cash. This could be a potential double top, in which case if we do see some weakness, this could be positive for a stock market. And the strength that we've been seeing year to date makes sense, as a lot of people have been liquidating their positions into cash, so cash has been stronger. So if we do see some weakness, this could be positive for the stock market. Taking a look at the VIX, or the volatility of the S&P 500 index, we were as low back again at the beginning of the year. Again, at the beginning of the year, there was no cause for concern. And then since then, it's been all downhill, it feels like. The VIX was around 16.5, and we've been on a roller coaster ever since, reaching a height of just below 40, going all the way back down to 20, back to 40, back to 20, back to 35, almost 40, 25, and then where we are right now in the 30s. And even being above 30 is quite high for the VIX. Even being above 20 is high for the VIX. So the fact that we've been up here for most of the year has been showing what kind of year that we have been having. Taking a look at the volatility of the NASDAQ 100, and this one I actually drew a trend line ever since October of 2021, and I drew a resistance of about 44. You could probably even drop this down to maybe 40 if you wanted to. And the reason I did this is similar to with a stock and price action, how the price action compresses between two trend lines. I want to see with this one, since it's been swelling, it has to choose either to break the resistance of 40 and we're going to see extreme fear, or we're going to break the uptrend and eventually see a little bit more calmness in the market. So which one's it going to be is anyone's guess. But the way these two, this trend line and this resistance, they meet up, it shows that before November we'll get a clear-cut answer if we're going to have extreme fear or more calm in the market. And lastly, I want to take a look at the 2-year and the 10-year yields. Both are closely watched by both investors and the Federal Reserve. So the 2-year yield is currently at 3.235, and the 10-year is currently at 3.238. So a difference of 0.003, essentially seeing an inversion like we've seen a few times before. And this is a very clear canary in the coal mine, kind of indicated that a recession is upon us. If we're not currently in it, it's coming shortly. Not for sure, but a very strong indicator that we're headed down that route. When you're investing in a government bond, you're expecting a much higher return on your investment if you're going to have your money locked up for 10 years opposed to 2 years, and they're essentially at the same rates. This is showing that the economy is very sick, but again, no surprise to anyone there, especially with, again, all the confluence of everything happening at the same time. It's been no fun for everyone. And one more chart I want to show you guys is the NMFI, the percent of stocks above their 50-day average. So we're currently at 14.65% of stocks in the S&P 500 are above their 50-day average. I'm sure a lot of that's going to be energy, of course. It's definitely not technology, I'll tell you that for sure. And the reason I'm showing you this chart is that whenever we reached a low level on the NMFI, it coincided with a good opportunity for a short-term rally. Now, of course, you have 2020 over here, which was an anomaly, going as low as 1.8% of all stocks in the S&P 500. But really, if you zoom out further than that, we are around a level of about 10, 15, where we saw bottoms back in the end of 2018 when we had that correction. And you zoom out further and further, it was a key area. The next key area would probably be around that 8%, and then below that, you're looking at maybe 5, 6%, and then that 2020 level of 2%. So we are in a key area, something to keep into consideration. Again, it's just an indicator. It's not a be-all, end-all, but just something to take into consideration that we could be hitting a potential short-term bottom for the moment into a short-term rally, but doesn't mean that we're at the absolute bottom of this entire crash just yet. So my expectation in the medium to long term is that inflation will inflect downward, is that we will still have that inflation. It'll still persist, but at the same time, we are going to see month-over-month increases that we have been seeing, and this will ease pressure off of the Federal Reserve to increase rates. In fact, potentially even decreasing them once they get some kind of confirmation that we're in the clear, but who knows when that's going to be. It could be the end of 2022 into 2023. So for that reason, you do have to stick to your plan when it comes to investing, whether that's dollar cost averaging or just waiting for that confirmation to happen. But again, you might be waiting and then it might be too late, and then you might not even get it. It's a very psychological game, this timing game, right? That you see it go up and you say, you know what, I'll wait till it goes back down, and then it keeps going up, and then you never start investing and you don't know, right? So again, that's the thing. No one has a crystal ball. No one knows for sure what's going to happen. You just got to play it how you see fit, what fits for your risk tolerance, your circumstances, what's going on in your life, and play it from there. Otherwise, that's the end of my video. Thank you very much for watching, as always. Please don't forget to hit that subscribe button and that like button. I'll be around for more videos, and I'll see you guys in the next one.